This show will be talking about various financial, business, technology, and investment topics. Nothing in this podcast should be taken as professional advice, as it is for educational purposes only. All topics are complex and require research. Please do your own due diligence. Enjoy. Thank you, ladies and gentlemen, for huddling back up with us today. I have the honor of talking about one of our toughest oppositions for over a few decades, and that is the student loan crisis. For us, many students who are millennials and Gen Z over the past 15 years have seen this become one of the most crippling issues as we try to get into the workforce. So it is my honor to introduce Farrukh Siddiqui, CEO of Defynance. Farrukh, how you doing today?
I'm doing great, Ayyan. Thank you so much for having me on. Really appreciate it, and I think what you're doing, is really an important thing for a lot of young folks.
Thank you so much, Farouk. It means a lot. It means a lot. But I think before we really get into the hot sauce, right, the hot topic of the night, more people want to know about yourself, right? Again, our audience is young. A lot of people looking to become aspiring entrepreneurs. So why don't you walk through your journey and how you exactly got to the finance?
Sure. I mean, I've been in financial services for too long, I think now. So anyway, but also spent a few years in technology, detoured into technology for a few years, and ended up at a company called Guidance Residential in the early part of this century. And they were working on a mortgage product that was based on an interest-free concept, co-ownership model, so different structure. Really learned a lot there and recognized that not everything has to be based on debt and interest, and there's alternative ways of doing things. And that's something that, when you're kind of in the normal finance world, nobody talks about that stuff, right? Everything is done in a certain way. So that really opened my eyes to a great degree. And after leaving Guidance, a couple of other original team members and management members had left. So we sort of came together and we said, well, why don't we continue this work, but do it ourselves? Because, we've kind of done it under the auspices of Guidance, but it's something that, we felt comfortable working on. And instead of just competing with Guidance, we decided to focus on a different area, which would be commercial real estate. So we built a lease to own commercial mortgage product for small balance commercial deals. So we knew a lot of people, business owners, entrepreneurs, professionals were looking to buy commercial properties as well, not just residential real estate. But there wasn't really anything out there that would be an alternative to sort of the normal debt-based financing. So it took us 2 years, from 2005 to 2007. We worked on that product, and literally, yeah, like the typical story, starting in the garage, two people in a garage, then became three, and then before you know it, in 2 years, it was about 20 some people. We had four offices in the country. So a whole team built out, talked to everybody in Wall Street in terms of all the major players, ended up working and partnering with Deutsche Bank, which agreed to structure deals according to the requirements that we had, wrote the contract to be different, took it to rating agencies, all kinds of other experts to make sure these contracts would be securitizable, that we could take them to capital markets. Got a top level servicing company, Pacific Life Insurance Company, to be the servicer for these assets. So everything was in place, and we even traveled overseas to kind of figure out the people who would invest from a secondary market perspective, to like connect those dots together. So a lot of work was done in those 2 years, and then we came to market in, I think, spring of '05, '07, and it took us about 4 or 5 months. We had about a $500 million deal pipeline, got a great response from the market as well. And then, the shoe drops, as they say. The financial crisis hit, and basically Wall Street shut down. And you remember those days with Bear Stearns, Lehman Brothers, all kinds of companies, institutions that were in the financial space that actually went out of business, right? That folded. So we were just a small shop, so we had to deal with our own issues. We did partner up with some community banks, executed a few transactions for some customers who were well into the sales process. Because with commercial real estate, you have so much going on when you buy a property. It's not just like residential; you do an appraisal and you're done. Here you have inspection, environmentals, engineering reports, all kinds of stuff that has to happen to even go through those transactions. So some of those poor folks were really hurting. So we had to figure out some solutions for them, but then I had to wind the business down. Um, And then took a few years. I took some time working with Lexington Insurance Company for a mutual insurance policy for homeowners coverage. But it was a proof of concept. Did that for a few years. But during this time, I just was thinking about, how do we take, really identify a major problem to solve. And by 2018, um, after extensive research, it became apparent that the student debt crisis had become that problem. I mean, I grew up in America. Student debt has been around forever, but it was never like this. And there's all various reasons about why this is happening. But the reality is that 44, 45 million people have student debt. Many of them are really hurting, and there needs to be alternatives. And again, going back to my experience of building alternatives to debt, so that was the focus. How can we do this in a way that doesn't involve debt? And the idea was to use income share agreements. So we kind of used that concept, applied some innovation to that, and really started focusing on refinancing existing debt. So I'll stop there. We can talk more about that.
Absolutely. And I think that story that you had, really just navigating through the financial crisis of 2008, is something that a lot of people will want to hear more about. So let's definitely push that to later in this conversation, because I want to help, especially our aspiring entrepreneurs, to learn what it's like to ride that roller coaster, especially during a time where even today, it would be very comparable to the 2008 financial crisis, what we had going on through the COVID situation. So but for now, I want to talk about the student loan crisis, right? You highlighted it. Nearly 45 million students are coming out of college with that debt. I think on average, $40,000 worth of debt per graduating student. And on top of that, the overall debt for the student market is about $1.5 trillion. You talked about how much it's grown in the past few years. To put into perspective, it was only about 340 billion dollars back 15 years ago, and today it's nearly 1.5 trillion. That's a 500% increase. And like you said, there's a lot of reasons behind it, but what is the finance really doing for these graduated students to help them restructure or refinance their existing debt? Talking about $40,000 out the gate when you're trying to get your life started, that's more than just the anchor holding you down.
Yeah, it's like probably the biggest gorilla that's on your back that you have to carry, through your starting your career. What Definance does is, in many ways, very simple. We refinance the student loan, which means we pay it off. When you work with us, you go through our process, get approved. We would pay off your student debt. So number one, that debt is removed from your credit report, which means that there should be a positive impact on your credit score, right? If you're considering buying a house or doing something else like that, it should improve your debt to income ratio. So you should become a better candidate and hopefully even get better rates to do that. So that's one huge benefit right off the bat. The secondarily, what we do is, because we are using an income share agreement, the payment that you have, it's tied to your income. So it's always affordable. Now we have an algorithm that we've built, and we use that algorithm to determine what that income share percentage is at the beginning. But once we do that, and once our customer agrees to it, then that is fixed. So the income share agreement could be from 5 to 15 years. But during that time period, the customer knows that I am sharing X percentage of income. It could be 5, 7, whatever percentage it is. But what that allows you to do is, you always know that this is what it's going to be going for this particular obligation, and you can always budget around that, right? From my perspective and our perspective, it's about financial freedom, right? No longer is debt there, so that if something bad happens in life, yeah, maybe that debt payment is affordable today, but if I lose my job, what happens? The payment's not going to go away, right? But with an income share agreement, it does stop. That's the beauty of it, because number one is tied to income. So if your income is going down, payment comes down because it's a percentage of income. But in our program, if your income goes below $25,000, then we automatically pause payments. It's not like federal student loans where you have to go apply for deferrals and forbearance and all those things. This is just, your income drops below 25,000, automatically payments are paused, where a lender would be doing what, right? Because if you don't have income, most likely you can't afford to make a payment, which means then you're have late payments, which are reported to credit, right? Late fees are charged. If it goes long enough, you go into default proceedings. You may end up in default, which again is a huge impact on your credit. right? So all of these things are happening. And even if you don't go into default, they give you forbearance or whatever, interest is piling up. So your balance is growing, even while this situation is going on. And that's what I kind of hate about debt, right? Because it takes advantage of people when they're in their worst position financially. And that's when we should be helping them the most, not taking advantage of their financial position. And that's what the ISA does. So in that situation, what we're doing then is we have a resources marketplace, which is the next benefit, where we actually will help people find a job. So we have career resources, career counselors, job boards, all kinds of other resources, recruiters, upskilling resources, et cetera, to help them. And other things like mental health counseling, wellness resources, credit, financial tools and tips, investments, etc. Because all those things also impact career, and we want to make sure because we've invested in people that we're always there with them in their worst of times, but also during their normal course of time. Because if they do better, we make more money too because we're still sharing the same percentage of income.
Absolutely. And I think that's the key that so many people need to realize with this alternative solution is that it's supposed to be a win-win situation, right? Somebody at the finance is not going to simply create an income sharing agreement that's going to put somebody's financial status at risk. They want to make sure that if a student or an individual that is not being able to, let's say, make a man or make up to their living standards, say, for example, 30, 40,000, whatever the minimum requirement is where you live, then Farouk and his team will actually step in and provide you with those resources to find help. Right? He said at $25,000 is the threshold that they have. Especially right now in COVID, you're looking at a lot of young students who just left college are having a very, very difficult time to not only get placed in jobs, but are also being actively tossed around between different landing opportunities. Right? So could you talk a little bit more about that resource marketplace, right? Especially for our young listeners who are looking to refinance their existing loans or are just looking for help to get into the market. How can the finance really be their home moving forward?
One of the things we just partnered up with an organization, and we just launched today is the first day, is this whole career counseling aspect. So if you have an ISA with us, you automatically get career counseling. You don't have to pay for it; it doesn't cost you anything. You get a live person you can talk to about your career, how to navigate your career. If you lose your job, even if while you're in your job, is it the best time to switch jobs? Am I making the right amount of money? Based on my experience and my degree and whatever it is, right? That resource also has job listings. It has recruiters you can that are available that can help you find a job. So all of that comes as part of your Definance offering if you have an ISA with us, right? And because again, we've invested in you, and we want to make sure you're going to be doing great all the time. And even besides that, we just launched a partnership with MoneyVerbs. MoneyVerbs is an app that has sort of gamified wellness, financial wellness. So they kind of teach you how to be financially literate and doing all kinds of interesting things, but in a more fun and interesting way, which engages people and so on, right? So that's a resource that's available, on Rope, and we call it rope, by the way, resources optimizing earning potential. It's the concept of a rope. You're falling down, you grab a rope to hold on, or you use a rope to climb in your career, right? And all the resources are the fibers of the rope to make it very strong, right? And that's what we're trying to build is a resource that's going to be meaningful for people. So anyway, so to answer your question, so we have this career counseling that we just launched. Financial literacy is going to be a huge component of it. We're going to be launching some networking resources as well to really connect people, and so on, mentorship resources. So all sorts of other things that are going to be coming on. But the cool thing is the opportunity is there for our early users to come on and help us learn, because to make it work, it has to be something that people want, right? So yeah, we have a certain concept, but we want users to come and give us that feedback that, hey, listen, yeah, we like this, we don't like this. You should kind of put this type of a resource in here. That's going to really help us.
Yeah, and I think right now with the way that loans have been taken over by for students, right? So if you think about it, for me, I went to school. I may have taken on 20,000, $30,000 worth of debt over my first 2, 3 years worth of schooling. But then I get into the workforce, and now all of a sudden I have this loan, right? I was given this money. I look at it; it's very attractive because of the fact that I have that cash, and now I know that I can at least moving forward be able to pay it off based off because I know how the interest rate works and whatnot. But for other students, right, or for most people, the idea of income sharing agreement might sound scary, right? Farrukh, I'm sure you've heard of that from a lot of people or a lot of your initial clients is that, well, dude, that's my income. I need that to pay my rent. I need that to pay off my other pre-existing debts. I may need that to help my family. How can you kind of go to these students and tell them, look, it's okay. What income sharing is actually doing is a win-win situation, but more importantly, it's supposed to be the preferred route, especially when you leave college.
Yeah. So at the end of the day, we have to account for the expense of education, right? So if you have the resources to pay it yourself, I would never want anybody to take an income share agreement. Pay it. You know, pay it yourself, come out from after school and in, take all the income and not have any obligation, whether it's debt or income share agreement or anything, right? And if you don't have enough income when you're in college, you may qualify for scholarships, grants, all types of other resources. Use those.
Yeah.
Minimize the cost that you're going to have to spend by yourself, like pay yourself, right? But if you have incurred that debt and you come out of college, would you rather have debt that would be there with you and which may be fine? Yeah, you may be able to afford that payment. You may have gotten a job, whatever. But what if you don't find a job right out of college?
Mm.
Right? We're in a COVID economy. 10 years ago, we were in a recession, right? And if you look back in history, it's almost like a clockwork. Every 10 years or so, we have something happens, right? We have issues coming out, recession or economic issues. So my point to all those people is that you have an automatic safety net with an income share agreement. You never have to worry that if you run into any problems in life, you can't make money, something is going on, that this obligation will either reduce or for a time period that you're not working will not be there as an obligation. So then let's say your income is 20,000, it used to be 40, but you're
Mhm.
doing some part-time job, whatever, just to kind of, well, you don't have to worry about making the income share payment. Use that money to pay your rent, to put food on the table for your family, or do other things, right? Instead of worrying about, making this obligation. But if you had a loan, you still have to make that loan payment. And if you didn't, it would be affecting your credit and making things worse for you. Where with us, that would never happen either, right? So I think that's one of the huge benefits. And on the upside, the scary part is, what if I do much better? What if I make a lot of money? Now, if I'm sharing my income, I'm going to end up paying so much more money. Yeah, there is absolutely a chance you may pay more money, but you're getting a lot of benefits for that too.
Mhm.
But even if you do pay more money, we have a payment cap. So there's always going to be a cap. Once you hit that cap, your obligation is over, even if it's less time than what you agreed to in the beginning for the income share agreement. We have a prepayment mechanism which allows you to make extra payments to shorten the income share agreement 1 month at a time. So you can take a 5-year income share agreement and finish it in 4 years by making extra payments. So you have that flexibility. You also have buyout clauses, so you can buy it out anytime in the middle. So we provided that flexibility too on the upside to protect people from not necessarily having to pay too much, but without compromising the downside protection that comes with it. And the last point I'm going to make is, if you go from 40,000 in income to 30,000, but you have two children and 30,000 feels like you're in poverty, you can still request a discretionary deferment.
Mhm.
You can tell us, hey, listen, I don't qualify for your automatic pause, but I simply can't afford this payment at this income level. So can I get, 6 months, a year off in order to find a job and so on? So we would obviously approve something like that. So that flexibility is also there.
Well, that shows the strength of the rope that you're talking about, right? When you're being able to lend it out to more people, or I use the word lend in a different way than what we're talking about with loans. It's almost like a curse word. But um, right now, for me, for example, right, if I go to you and I say, look, I'm a student that has about $30,000 worth of debt, and I'm expected to make around $70,000. But there's another student, let's say he has taken on $60,000 worth of debt, and he's only expected to make 40K in salary. When you talk about that rope, is the rope longer for me in terms of preferentials for you as a company, right? I'm thinking about this from the creditor perspective, right? You coming from that the lender's background, you understand that there are certain risks that you as a lender are willing to take on. You may charge those with a higher higher risk tolerance, a lower interest rate, and those with a lower risk tolerance, a higher interest rate because of the credit risk that's associated with them. So with the ISA, is there a similar concept that goes into it, right? Is there some sort of, okay, I know that Ayyan will be making more money. Is he a preferred customer versus student B, who is not as financially stable? His degree might not be the most valuable in today's job market. So how does it go about adjusting?
Yeah. So you're not a preferred customer because of the amount of money you're making, right? Um, I just don't like the concept of a preferred customer to begin with. Like, we're not preferring any one person to another. But we do have to evaluate risk. We have a fund that's funded by investors. We use that money to refinance student loans because the money has to come from somewhere, and we have to provide a return to those investors. So we've designed our program to be a very good balance for the consumer as well as for the investor. Because if we don't provide benefits to both sides, it's not going to go anywhere, right? If you want to give all kinds of returns to investors, which means the pricing is going to be expensive, then we're not going to get people to refinance anyway, so they're not going to get returns to begin with, right? And if we're not giving them enough returns, we're not going to get people to invest, which means we're not going to be able to help anybody to begin with. So it's got to be a balance. So that's the first point. But to go back to your example, you said someone making 70,000. So let's say we have two people making $70,000 in income. One person
Mhm.
comes to us with 30,000 in debt. One person has double that, 60,000 in debt, right? So how do we look at those people differently? So it's not that one person is preferred or another. We would evaluate them based on their academic background, based on their income history, based on their profession, right? Their job performance,
Mhm.
all those considerations, and we will look at credit factors. Now, one thing we would be different than lenders is we will not say we will make a decision based on your credit score. We're never going to say that, right? Because again, for young people, credit scoring is not a very good indicator of their credit worthiness, right? So, because credit scoring is based on your utilization of credit, the amount of credit you have, the length of your credit history, those are major factors that go into a credit score, where there's no way for a young person to have any of those that's favorable to them. It takes a few years to build that history. So, it's just not fair for us to use that. We would never use that. However, we do want to make sure you're responsible. You're not making late payments. You don't have a bunch of collections on your credit score. You haven't like filed for bankruptcy, stuff like that. We're looking at those things, and we've built the risk adjustments for those factors, along with the type of profession, your academic background, and so on and so forth. Now, so if those things are all fine, then there's no difference between that 70K person who's got 60,000 in debt or 30,000. The difference is going to be that because we're funding a larger amount, the one person may have to have a higher income share percentage to provide the return to our investors, because there's a lot more money invested in that person versus the other person, right? Now, it could also be that the person with the more debt, the income share percentage goes over 15%. We want to keep income share percentages below 15%. In very rare cases, you want to go a little bit above, but typically 15 or less. So then, let's say if that's happening, if you were a lender, we would say, well, sorry, we can't work with you, denied, go, bye bye. Okay, we will still tell you you're denied, but the difference is we're going to say, listen, here's some rope partners that can help you. Now, how can we help that person? Go to our credit partner, see if your lender will be willing to reduce your debt for a lump sum payment.
Mhm.
So maybe they can go and say, look, what if can pay you 40,000 right now? Can we pay off my loan? You'd be surprised how many times lenders would agree to stuff like that, right?
Yeah.
So I think that's one way of handling that problem. The other way is like we have partners in Rope that help you pay down your debt faster. So you can work with them, take a year or so to bring that 60,000 to a little bit below level where you can qualify, and then we can work with you then, right? So for us, it's never going to be, hey, we can never work with you. It's always going to be, yes, we can work with you, but transparently explaining to them why, and then show them the ways that they can fix that problem to come back and apply again.
Yeah, I mean, based off of what you're saying, I'm totally sold, right? Because for me, I always look at the private markets to help bring these solutions to larger issues that face our country, right? I always say that the private markets is where innovation will happen, and more importantly, it's where the actual money to fund sorts of solutions will come from. And based off that, I kind of want to get into our next section of this podcast that we want to call the 2 minute drill. right? It's going to be a lot of shot fired questions, a lot of quick answers that we're looking to get out of you. And for me, the number one thing that I'm thinking about right now is, will this solve the problem at heart, right? You heard about a lot of politicians as of late have used the platform to describe the idea of canceling debts. Regardless of your political beliefs, we both can agree that that is more so a bandage on top of the current problem, and it's not actually getting into the plumbing and piping of the situation. So, in the long run, what Defynance is doing, do you see the data that you guys accumulate? Do you see the business model that you're trying to incorporate being something that will help drive the government to actually come to a reasonable solution? Or if not the government, at least help students realize maybe in the long run, in going down the alternative financing routes are the better solution as opposed to taking on federal debt?
Yeah, I mean, let's answer that question, from a short-term and long-term perspective, and also the micro and macro perspective, right? So I think the short-term problem that we're solving is the individual people's debt burden, right? So yes, the Definance solution will take you completely out of debt
Hmm.
right away and solves that problem in the short term, right? So 1% at a time, we will do that, right? Now, to your point, like what is the long term outlook? And I think the long term outlook starts addressing this thing on a macro level, because let's say 5 years from now, we've funded, 20,000 ISAs, 50,000 ISAs that are in our fund. Now we have data on 50,000 people and their income trajectories, what's going on. We can track back and say, hey, someone went to New Jersey Institute of Technology, right? Or
Hmm.
they went to MIT. Okay, MIT cost them X amount of dollars. Let's just say NJIT costs less. Well, in that case, did you really benefit from going to MIT? Now, maybe for certain degrees, yes, it makes sense. But for other degrees, it may not make as much sense because the disparity is not as great, right? So that can show students that, look, let's make smarter, better decisions. And maybe I use NJIT and MIT as bad examples, but there's much better examples than that now that I think about it. Um, from like private to public universities.
Hmm.
Um, but the point is that the cost of education, does it justify the degree you're pursuing and what potential income that comes out of that degree? I think we can, it's not just about guessing, we can show that with real data over time. So many students hopefully can make better decisions. And hopefully, by documenting that, universities can recognize that they can't necessarily get away with it like I think they are to some degree now, right? Because they're looking at all students with the same lens. Like, we
Yep.
don't care if you are going to our university, you may be pursuing, equestrian science, horse breeding,
First.
or you may be pursuing, a pre-med where you're going to go to medical school, but we're going to charge you the same amount of money. But the reality is that those two professions may not have the same outcomes. So why should both of those people have to pay the same amount of money, right? We need some equestrian scientists in our society as well, but we need doctors as well, right? So, but if I like horses and I want to study that, why should I have to pay so much more money? But because that's a passion of mine, I'm okay making less money coming out of it, right? Coming out there because that's a passion. So we want to, like, as a society, we want to let people pursue their passion because we need a lot of things. People think, oh, we need our doctors, engineers, and high skilled STEM people. Yeah, we need those folks, but we also need the social scientists. We also need the social workers. We also need all kinds of other folks. So I think it's important to treat them all fairly, and I think hopefully over time we'll be able to demonstrate that. And the government too. I think this is something that the government needs to recognize, and they have to change the way they fund education to also align the incentives better between universities and their students.
Absolutely. And I think one thing that you brought up that was very, very interesting was the point of the value of education. Nothing against any equestrian majors that are out there. We love you.
I know someone, so that's why I brought that one up.
Yeah, but that's the thing that a lot of students today are facing, right? That's the problem that we always hear is, especially depending on your background, you are told that you have to go and pursue an Ivy League education. You're told to go to the West Coast and go study at your UCLA's, your Stanfords, and USC's, right? All of these institutions based off of their prestige, not realizing that the prestige itself doesn't really, most of the time, doesn't really add value to the individual, right? It's the individual that makes the degree what it is. The reason I say that is because I could go, for example, when I was a student over at Boston College, I realized the difference between myself and many of my other peers was the positioning that I gave myself, right? I was actively pursuing networking events. I was actively pursuing time with my professors, so much so I'm pretty sure that they blocked my emails moving forward. I was the one that was going out there and trying to participate in new clubs and new opportunities. So, what what kind of advice would you give to a student that's just entering college, right? A lot of what we talked about with the finance was post graduation. What about those who are getting into school? What advice would you give to them? Obviously, you said that data collected from Defynance in the future will help make these decisions, but today, being someone that's navigated through American education systems yourself.
Yeah, and I don't mean to say anything against the Ivy League schools and these great universities, and because these are institutions and they produce amazing results, right? So there's nothing against that. And if you can get in there based on merit and qualify for scholarships where the cost of education will come down, I mean that'd be silly not to pursue that,
Yeah.
right? Go there, absolutely, why not? you know but to pay a lot of extra money just for the prestige, um okay, yeah, there's some value to that, but then you have to really seriously ask yourself, how much money, how much cost that you're willing to pay for that. And I don't know if students, 18, 19-year-old kids, are really asking themselves those questions.
Well, I think that's the time that students really need to take now. Is just more so in the data information, right? That we live in the world where data is available everywhere. Um, Going and looking at what does exactly mean. If I am a doctor, I agree with you. Going to these larger institutions is very, very important because of not just the prestige it brings to individuals, but because of the fact that it gives you more opportunities. The network there are larger. The alumni there are very close knit. So there are factors like that. But like to your point though, how could you? Because one of my biggest gripes with high school and the schooling system today is that it doesn't really give students the knowledge or the background to budget or do analysis on their own. So, say I'm a freshman or someone looking to become a freshman at college, what advice would you give to that student to navigate the college world?
Yeah, it's not so much about where you go to school. I think it's more about what you learn. Like when I was, like a couple of my kids are in college. So, when my daughter, she's the older one, when she went to school, so we sat down and we jotted down a few courses that I thought, they're like must take courses. You can study whatever, major in whatever, but there's a few courses that you should take, right? So I think there's certain skills everybody should develop when they're coming out, right? Like I think communication is such an important skill, and for some people it comes naturally. Like Ayyan, you seem to be the kind of person that comes naturally, right? Like you can communicate. You can communicate verbally in a written format, whatever. But if you don't have those skills, especially speaking and public speaking, right? I think every student, no matter how shy you may be or whatever you may be, you need to develop that skill, because that skill will take you to places that just your degrees or would never take you. I've seen people that may not be as intelligent or as smart as others, but because they're able to have those types of skills, they're able to progress and do very well in their career. So I think that's just one example. There's some few other skills as well, but that's what I would kind of focus on with students, is that do that. And then don't worry about necessarily, because even with college, right, you can still go to a Harvard if you want to, but you may be able to go in different routes. You may be able to transfer from another school. You may be able to go to a community college and save a lot of money and get an associate degree and then transfer over to, because at the end of the day when your bachelor's comes out, it'll still say that university's name. It's not going to say half of it was at an associate, right? So it doesn't really matter in that sense. So I would just say, you have to be smart about this, and talk to some people, right? It's not just like, there's guidance counselors and all those people, but find good mentors. Even at the
Absolutely.
high school level, find good mentors, because we all look up to people, right? We all have different aspirations, different careers we want to pursue. On a personal level, there's different people, but talk to those people and really learn to listen and hopefully reflect and take some action. Not just give it some year and forget about it. Right? I think these are some of the things that I would kind of advise people to do at the early
Well,
stages.
well, talking about that mentorship role, I know we only got a couple of minutes here, so I want to get into what I personally want to learn. Right, you're somebody that navigated through the 2008 financial crisis. You went from the soup to nuts process of building up a company. You talked about having half $1 trillion worth of a deal pipeline ready to go, and then all of a sudden everything comes crashing down on you. Um, you talk about the mental stress of that situation, coming back and saying the next day, no, I can still do something and still succeed, and then nearly only a decade later bounce back and create Definance. So for our audience that are aspiring entrepreneurs, that are people that are looking for that, those words of wisdom, what would you say to them, especially being someone that's navigated through some of the most difficult times in United States history financially?
Well, the reality is that every single person will suffer highs and lows, right? Nobody's immune from that. Everybody will suffer that, and it could be a career, it could be a personal life, it could be anything. But I think the one basic thing that just a personal faith is that, if I am dealing with something that's a low of whatever type, um, God would not give me that without first knowing that I can handle it. So, one, you have to believe in yourself. No matter what's happening, you have to believe that you are able to handle any situation that's coming your way.
Mhm.
So, I think that it starts off with that, because a lot of times people feel like, why me? And, can I handle? No, yes, if it's happening to you, that means you can deal with it. So, as the expression goes, man up, right? And kind of figure that part out right away. And then you're not alone. There are resources available to help, right? Don't ever be afraid to look for help and ask for help. It's out there, right? Because you don't have to carry all the burden yourself. you know there's resources to help you. So I think once you have those core principles down, then it becomes easier to handle the stress, and kind of, then just plan it out, one step at a time. Problems don't get solved by going from A to Z. You got to go to A, B, C, D, slowly, one step at a time. And it's a process. Work the process. I'm also a sports fan. Forgetting now, my own team's the Sixers, right? What was their whole thing last few years?
Trust the
Anyway,
process.
trust the process. There you go. Trust the process. So I think those are some of the key things that I think people need to understand to navigate any kind of problem in life.
Absolutely, and I think the problem that a lot of students are facing today, they can certainly learn a lot from you, and to especially learn and actually be a part of the finance as well. So, last part that I want to get into is where can people learn more about yourself, and where can people learn more about the finance? Right? How can we be a part of this evolutionary process? How can we also start leveraging these resources that you have? Look, I want to grab onto the rope. I want to start pulling myself up. Where do I go?
Yeah, if you go to definance.com, there's a rope link there, so you can go access the resources marketplace, apply. You can apply for the ISA. You can request information about our refinancing fund. If you're an investor, we can work with you. You have to be accredited at this point in time. Down the road, we'll open it up to other people. So that's a place to go. You can always find me on LinkedIn. Love to connect with people and talk. I've done some webinars on navigating the student debt or student loan or student financing landscape. If you want to, open that up to your audience, and we can set up like a, co-sponsored one with the Wealth Huddle, and get you some of your folks together, and we can design a webinar, talk to them about, answer their questions. We can do any of that. And if you want to support us, we have an equity crowdfunding campaign going on Net Capital. I'm sure you'll provide the link with these videos.
Absolutely.
So if you go to Net Capital, you can actually invest in Definance. You can own shares of Definance and really become a part of the solution, help us solve the student debt crisis. And just at minimum of $99, people can invest in Definance. They don't have to be accredited either. We wanted to take this to the crowd. We wanted to get the support from the crowd because it is a problem for the crowd. It's our problem together. I think it's important for all of us to solve it together. We want everybody to be a part of that if they want to be. So I definitely encourage that happening. That's going to be going on for a few more weeks. So definitely come and support us on that side.
Absolutely. And I want to thank everyone for joining us today and helping us huddle up and come up with a game plan to really tackle one of the biggest crises that students, millennials, Gen Z alike are facing, and that is a student loan crisis. And I want to give a special shout out again to Farrukh Siddiqui for joining us today and talking about the finance and what you guys are doing. I myself, I think one of the most important things that a lot of you students can do who are listening is is actually participate in this crowdfunding round, right? This is not investment advice. I'm not telling you to go out there, but there is no learning like skin in the game, right? So if you want to be a part of the solution, might as well put your money where your mouth is. Take some time, learn more about the finance, and let us know. Farrukh already thrown out the offer. We would love to host a webinar with all of you guys. Talk more about the issues that you guys are facing. How can you better navigate through your current student debt as well as your educational circumstances, right? And we want to make sure that we can help put you into the settings that are most optimal for you. So once again, thanks for huddling up. Let's make sure that we can get Farrukh and his team to meet their crowdfunding goals and really lead the revolution behind the student debt crisis.